You've got to be tenacious about this. You've got to be creative and differentiated about this. In our space, you've got to be mission driven and super passionate. I mean, I think if you don't bring that passion to bear, it's hard for me to get excited if you're not excited, right? Like that's just the way it is.
On this week's episode, we welcome back to the tank Peter van der Velden from Lumira Ventures to discuss the evolving landscape of venture capital in the life science arena. Peter shares why life sciences have outperformed as a venture capital asset class and the key drivers for its overall success. We also tackle some pressing issues Peter has been vocal about recently, specifically the implications of Canadian pension funds not investing significant capital in sectors like life sciences, ag tech, and AI, and what that means for our domestic innovation ecosystem. As a former chair of the Canadian Venture Capital Association, the CVCA, Peter also shares his insights on how organizations like the CVCA can effectively advocate for domestic investment and support Canada's venture capital ecosystem. We switch gears and delve into the biotech industry's buzz around GLP-1s and the transformative impacts drugs like Ozempic, Wegovy, and Mounjaro are having on society. We discuss the shift towards treating obesity as a disease and the potential of next-generation therapies and what this all means for healthcare investors. Finally, Peter shares his thoughts on the current state of venture capital, along with some valuable advice for emerging entrepreneurs and investors looking to make a significant impact in the Canadian life sciences and innovation sectors. But before we jump into this week's interview, we welcome back to the tank John Ruffalo to discuss the news and stories making headlines in the tech and venture capital ecosystem. Welcome back to the tank, John. How you been?
Great, Matt. How are you?
I'm pretty good. We're going to take you back down memory lane here for a bit, John, just for our listeners here who are following the news and the headlines regarding Super Microcomputer, a data center hardware company that has faced a significant stock decline, losing about 2/3 of its value since being added to the S&P 500 in March of 24. The news swirling around is that their auditor, Ernst & Young, has resigned regarding some integrity issues. Now, for our listeners who don't know your backstory, do you mind giving it to us and then maybe explains what happens in these situations?
Yes, and I think that followed a report, was it Hindenburg or one of the short selling firms?
Yep.
That had concerns around their revenue recognition. So yes, the haunting memories it brings back was I was a very young global partner with Arthur Andersen. And there was this one client that we had that everyone was so proud about that could do no wrong, and they were called Enron. And 6 months later, the firm was gone. I'm not suggesting that's going to be the same thing by any stretch with E&Y, but for an accounting firm to resign and not sign off of financial statements, it means that they do not trust management and their representations. So that's a very serious resignation.
Right. And so just for our listeners, the Hindenburg Research Report, which is known short seller of stocks, came out in August 27th, 2024. So not too long ago, basically saying that there's evidence of accounting manipulation, sibling self-dealings, and sanction evasions regarding the company, which has been a huge high flyer regarding obviously everything happening in the data and the AI space. Do you have any insight or what you think will happen here, John? Where there's smoke, there's fire, you think?
My only recommendation is when people go, wow, there must be a great buying opportunity. My only advice is, folks, where there's smoke, there's fire. And it feels a little bit like all of the buying that occurred when Silicon Valley Bank, announced, some issues on there and people jumped in to buy the stock and then lost it in about 3 days. Not predicting that's what's going to happen. But generally speaking, I think there's probably a lot more to this.
Okay. Well, we'll have to wait and see, John. So hopefully it doesn't give you too much PTSD. But moving on, obviously, we've got some big news coming down the pipe in the next week or so. We're running into the U.S. elections, where it's a head-to-head race here between Donald Trump and Kamala Harris. And everyone's coming up with their October surprises. Trump's voters are garbage, yada, yada. I think I want to focus on what this means from a Canadian lens. So there's been some articles talking about how in the Globe, Donald Trump is good for financial institutions in Canada or other parts of the NAFTA agreement, things like that. Where do you sit on what Trump means for a Canadian economy? Do you think it's going to be good? Obviously, depending on where our federal election lands in the next year or so. But how do you think this is going to impact the Canadian economy and Canadian institutions?
Yeah, it's interesting because I did see all the various surveys that I think the general sentiment is a presidency led by Kamala Harris would be better for Canada just because of Trump's attitude towards tariffs, etc. I have a bit of a different take in that I think it doesn't really matter at the end of the day. My view is the United States, given all of its advantages that it has, ultimately, I don't believe really that the president can really do too much good for the nation and too much bad, because they're replaced, and there's just such a massive machine that operates the United States. I think at this point, if everyone listened to both sides, both are utter disasters, and yet ultimately both would probably not be utter disasters, and the 4 years will go by, and hopefully this insanity is going to stop. But I'm not optimistic on that either.
Well, I know it definitely doesn't feel like it matters at the end of the day. It really matters what happens here on the home front, I think. And when our election, whenever that happens, is really what's going to change the outcome for us, not what happens necessarily south of the border.
We should be worried about our own situation here to help us move forward in the future. The one thing that I would say that is going to be fascinating, I didn't expect this in this way, but the role of mainstream media, I think we're going to look back as this is a turning point on the irrelevancy of mainstream media and how the media has become polarized in and of itself. And this whole notion that media is supposed to be a distribution channel and not take positions on either side. This election has been the most egregious that I've seen, and I can't wait to ignore all of the mainstream media who have gone on both sides out of their way to view things on the same set of facts in such contradictory ways that now I could see the damage that they're doing to their long-term credibility.
It's quite obvious. I mean, I was literally having this conversation with my wife the other night about how you could just flip between the channels and see how they twist one story, the same story, one way to their side versus the other. It's unbelievable. The other thing, though, that I think often about is last week we had our episode with Alex Albin released, who is founder of Theo AI, but also used to work under Walter Cronkite on the CBS Nightly News a long time ago. And he was saying how during the last election that he worked under Walter Cronkite, he was known as the most trusted man in America. Everybody listened to him on the Nightly News. And what he said was the truth in everyone's eyes. And I just feel like we are so far removed from those days, probably for the better, because now we have much more distributed room for thought and so many platforms to consume. But the problem is the spikes of what is real and fake are so much higher and have so much more broader impact that it's really hard to consolidate them into just 1, 2, or 3 nightly newscasts. And I think that's what we're starting to see now. It's really, really difficult.
Who would have predicted that the most powerful media swayer of opinion is Joe Rogan and could demand that a presidential candidate goes and visits him?
Yes.
That is telling of where the landscape has actually changed.
Hey, from Fear Factor to interviewing the next president.
I know, eating bugs to hauling garbage or whatever joke you want to use.
Okay, so this episode will come out obviously on close to the day of the election. What is your prediction? Who do you think it will be? And then I'll go after.
So here's the best that I can do. If you follow the trends in the polling and correlate the polling to what the experts translate to the Electoral College, you could see Trump winning narrowly. If, however, the Harris campaign is able to use their significant dollars to encourage people to vote in absolutely massive record numbers, you could see that despite her narrowing lead on the popular vote, it actually translates into more Electoral College, assuming they get this massive electorate out. So I would say if there is a massive increase in the number of voters, that will go to Harris. If it's more in line with just the increase in the population from 4 years ago, then that I could see that going to Trump. So that's kind of the way that I see that. But I just read, some of the people who I trust most, and it just seems that everything's within the margin of error.
Just to be clear, you're saying popular vote just narrowly goes to Harris, and you say electoral college goes to Trump.
With the exception, yes. In both circumstances, I think popular vote to Harris. But if it's massive voting numbers, she will get the electoral college as well. But if it's more in line with historical voting numbers, other than an increase in population, that the electoral college will go to Trump. That's how I see it.
Okay, so I predict that the popular vote will narrowly go to Trump. I actually think he'll narrowly get the popular vote. I know it's a bit of a crazy take, and he will, obviously, if he gets the popular, you get the electoral college. But I also think we will not know the official results for several weeks after election.
You know what I worry the most? I do hope that it is a convincing victory for one or the other.
Right.
But I'm really worried it's going to be narrow, and this is where the problem is going to be. And I think we're going to be in that problem land.
I mean, Harris's team already said they have a team waiting to do the same thing that Trump tried to do last time. And so I think they're just going to tie it up in the courts for too long, and it's going to be a shit show to get through all of it. But let's see how that goes. But let's switch gears to something you and I had talked about several times here, which is how a lot of the competing LLMs out there are starting to see venture funds hedging their bets. Business Insider had an article about this, about how VCs are hedging their bets, backing multiple competing LLMs like Anthropic, like OpenAI, like Cohere, which is going against a kind of a bit of a venture taboo from prior years. Our friend Shil Manat at BTV said, I'm seeing more VCs investing in competing companies than ever before, all in AI. And some people, at Tomvest, Umesh Padval says, I think it's really flawed and very unethical to see someone who he is back Cohere, obviously from Canada, also investing in Anthropic, OpenAI, and so on. So what are your thoughts here? Is this a taboo thing that's over with? Or do you think people are just trying to make sure that they pick a bunch of options and see one of them become the winner?
You could always go to Las Vegas and pick all 37 numbers and roulette and think that you're winning. I guess you can do that. I actually do think it's morally offside. As an investor, our job is, if you like a certain space, your job is to figure out who you think the best company is in that space. And it's okay if you realize that you've made a mistake and then invest in a competitor later on. But to do it at the same time, here is the moral problem. We get a lot of ideas, business development opportunities, you name it. And it comes in through the investor. And then which portfolio company do you decide to help out on that? How do you decide? I think you run into a real moral issue. What does happen is you might invest in two companies that you think are in different markets, and then over the course of time, they converge. And that's okay. And then what you try to do is you try to put up walls. Here's the truth of the matter. Those are the most porous walls you can imagine. VC firms are relatively small. Despite your best efforts to put up those walls, it really doesn't work. So I do find it so odd when firms just say, you know what, I can't figure out the best company out of these six, so I'm going to invest in all six of them, and may the best horse win. Well, I guess, that's there, you could operate like a hedge fund, but where is the value add in all of that?
Well, I think that also, people concerned that there is sharing of information. A lot of the times investors don't have that much information of the inner workings of companies, especially at this scale. But I definitely see the point here, especially when they're very clearly competitors. The way we avoid situations like this, when we don't know, especially at the early stages of investing where we are, where the companies will end up. And if there's any sniff of overlap potential in their product roadmaps, we actually have the founders talk to each other before we choose on making the other investment to make sure there's no overlap and everyone's on the same page. I don't think you're going to get Cohere and OpenAI talking to each other about their roadmap overlap. So you can't really do that at this stage of the game. But OpenAI had reportedly asked investors in their last funding round to refrain from investing in 5 competitors, which is quite unique. Obviously, that was rumors and never confirmed. But I do see the point in all this from the company side. I guess the question is, what do you do on the investor side when there is this winner-take-all mentality, but you don't know who's going to be the winner and there's 5 competitors vying it out? What would you do? Just invest in none of them, John? Or pick the one you hope and think is the best for you?
Well, it's funny. This question was asked. I was at a conference in Los Angeles. This was back in February. And this exact question was asked of Founders Fund. And they said, on foundational models, why did you put only your money into OpenAI and have not considered anyone else? And they kind of just said, we have no idea who's going to be the winner, but they did their homework, and on their best view, they thought that OpenAI was going to be a clear winner and maybe was going to be a horse race of 3 or 4. But they just said, put all of our money in there, and they've proactively have said no to everyone else. I kind of get it, and they're kind of putting their money where their mouth is. And they put in a very, very sizable check, but it makes it very clear to them that they only want one horse to win. It's not going to be a complete winner take all, but it will be a horse race of a very, very few. And, isn't the job of a VC to ultimately use your own judgment to figure out which is the best company in a particular space out there? So
you would hope so. But in the same vein here, John, I want to get your thoughts. So there was an article written in the Information about how we might start to see some movement on the M&A side in 2025 regarding some of these bigger M&A type deals if Lina Khan is pushed out, if Trump wins FTC chair. And some of the names that come up are some of the names we've talked about. It's the Cohere's getting acquired by SAP, Oracle, or Snowflake, or Salesforce, Mistral by Apple, Microsoft, or Amazon, Perplexity by Meta, Hugging Face by Meta. All these names that we kind of hear about who are burning gobbles amount of money are now being talked about on the M&A side right at the time of the U.S. election happening. What do you think will happen in 2025 with some of these big names?
So I'm going to be a little bit contrary here because I've been bitten on the wrong end of this very situation in other contexts. If you call it, the space is consolidating and you're an independent and there's a few big leading companies that are starting to consolidate, and then you see one of those consolidators buy one of your independent competitors and bought it for a very good price, what you start to go, wow, well, if they bought that for $500 million and I'm a better company, Jesus, ours must be worth $750 million. No. What actually happens is, and you think your value is going up on scarcity value. I've been burned the opposite way. The opposite occurs. You want to be one of those first few that goes out because those consolidators kind of get desperate. But then once you start making your big 1 or 2 acquisitions, you start to go, do I really want to spend another $1 billion on the next one afterwards? Or do I just simply wait it out, crush them in the marketplace, and then take their best employees later on? So I think you're actually going to see the latter occur on this because so much capital has been spent already. And what we're also witnessing is people who are working for these LLMs are moving around like crazy, and they've got these massive secondaries. They cash the check and they leave. So what do you have at the end of the day?
Yeah, I heard on a podcast the other day, we're in the cold war of AI talent race right now. And it is really hard to keep companies afloat when you've got that such demand for the talent and you've got this amount of funding being burnt through the business where it's not sustainable for long, where you need an acquirer to step in and continue to fund it, or Meta's just going to continue to take it off their own balance sheet. So we'll have to wait and see, John, but a big week coming up here. Thanks for joining us in the tank today.
Great. Thanks, Matt.
Now let's jump into the tank for this week's episode with Peter van der Velden. Thanks for joining us back in the tank today, Peter.
Hey, it's good to be here. It's been a while.
It has been a while. The last time we had you on the tank was back in October 2021, almost 3 years to the day, alongside Anthony Mushantif from RBCX, now who's the co-founder of a biotech company, funny enough, called BioSil, where we talked about Canadian LPs and sort of the waking up to the biotech industry, which still feels like the message you are singing today, isn't it?
100%. We'll talk a little bit more about that today.
We will. But let's start high level for a bit of a particular, before we get into the spicy topics. It would be great if you can give a little bit of a background for maybe some of our newer listeners who don't know you so well, what your current role is at Lumira Ventures and a bit about your background.
Yeah, so I'm the founder and managing partner of Lumira Ventures. We're the largest dedicated life sciences only manager in the country. I spend most of my time around sort of the strategy part of our business and the HR part of our business. We've been transitioning the team over time so that my colleague in Boston is taking over more of the day-to-day part of the business. And so I'm having a lot of fun spending time on the things that I really like in the venture ecosystem these days.
Absolutely. With over 3 decades of experience in investments and operations, you've seen a lot of changes in the venture capital landscape, especially in life sciences. What are some of the biggest changes you've seen over the last little while?
Well, I think 3 decades is a massively long time. So maybe I'll parse it down and not go all the way back to Genesis. Look, I think the last 15 years have been the most transformative in venture in a long time. You go back to 2010, this was a broken ecosystem in this country. And we had some real engagement to change that. We had Ontario Growth Ventures set up. We had the Quebec set up with FSCQ, CDPQ, IQ, all kind of funding terrorists to get that. And then we got the VCAP. And so we finally had a source of kind of capital to start this venture engine over again. And look, we've had tremendous growth in 15 years. I think that's come with some real positives and it's come with some challenges as well. In 2011, this was a nascent business. It was dominated until about 2014 by VCs. And then we started to get more and more generalists piling in as the momentum for the sector started to grow. We had this real shift to this focus on what I call unicorns, what I think are probably the most elusive beasts on the planet. We started to get this focus on mega deals. The acceleration in value change started to have people focusing on TVPI versus DPI. We started to get comments like private capital is cheaper than public capital, which, sounds insane to me as a long-term capital allocator. Hold periods started to go up. And then, I said this in 2021. I think if you look at the entire VC landscape, people who call them venture capitalists, about 75% of them will have been in the business less than a decade. And most of those people have been in the business less than 5 years, and none of them will have been in a downturn. And so I said that in 2021, and then guess what? We had a downturn. And so now everyone's got that experience. So we kind of had a boom. I think we've had, a reset for 2021, 2023. We're back to a pretty rational market again, but with some challenges, right? And we can probe that a little bit further, but I actually think this is healthy, right? I mean, I think we're in a market now where it's back to being a VC-dominated market. It's back to a market where people can have the time to do thoughtful due diligence and where relationships matter. I think syndication matters and people are spending way more time on getting good, high-value syndicates. We've seen corporate investors come in a much more significant way, particularly in our space. Our last 5 deals have all had a corporate and a meaningful corporate in those deals. And again, they're really high-value players. I think the market's bifurcated. The top 10 or 15% of the market is getting big, fully syndicated, deep dive deals done. The bottom 25% of the market is probably in deep trouble. And then the middle is, I think there's a lot of value, but there's a lot of work. That's how I think the market sets up now. And we can talk a little bit more about life sciences in particular, but that's kind of a holistic view.
Yeah, before we get into the negative side of things, let's talk about some of the positive aspects, because you've been a vocal thought leader around how well the life sciences industry has outperformed the rest of venture capital as an asset class. I'd love for you to share some of the factors that you believe are contributing to this, because you've talked about government support, research institutional support, the talent pool, sort of the collaborative nature of the ecosystem, and obviously the strong IP that's coming out of it. But maybe give us a little bit more nuance to why you think it's outperforming the asset class overall.
Let me context that a little because I think it's important. When we started our first fund as Lumira in 2012, we had a goal to do one unicorn type company. And that was a pretty heady process because there hadn't been a company of that ilk in Canada in about a decade, right? If you look at that fund now, which was a $121 million fund, that fund has had 3 unicorn exits, 2 of them Canadian. So just for context. And then if you take that a step further, since 2019, there have been 10 exits of Canadian life sciences companies that higher than $1 billion of value. And by our estimates, those exits account for 70% or more of all liquidity in venture in Canada over the last 5 years. So it's a massive number. And then if you look at the BDC's 2024 report, life sciences outperformed every other sector, both on a DPI side and on an IRR side. So, those are macros that are out there. So coming to your question, what's driving it? Look, 2 decades ago, we sequenced the genome. And it took a decade or more for the consequences of that to really start to come into the marketplace. And so if you look at just cancer as an example, from 2000 to 2014, the number of innovative cancer products only doubled. There was progress, but it was, slow. Since 2014, we've had a threefold increase in the number of therapies, particularly in terms of targeted therapies, in terms of drugs and biologics. So a fundamental change in the pace of innovation and how that innovation is translating into usable products for patients. Then you look at the other drivers. Look, we have huge demand growth, right? China, India, just from a macro point of view, are becoming much more middle-class markets. All middle-class markets want more healthcare. And then we've got the aging paradigm, which really affects every single part of the first world. So huge demand drivers growing kind of exponentially. Then I think the big evolution that's also happened in the last decade and a half is big pharma has largely become commercializers versus innovators. And so if you look at the last decade or so, 70% of all innovation that's been brought to market for patients originated outside of big pharma, and they either in-licensed it or they acquired it. So that's a fundamental change, and it means that the impetus for driving innovation exists in the kinds of small companies that my peers are funding, nationwide and around the world, right? So that's a big change. And then the other part that's important here is those big companies have a natural life to their product portfolio. So if you think about what's different is if you're on Microsoft Office, you might have had that product on your desk for 25 years, right? Hasn't changed. It's the same product. It's always there. It exists every year. And Microsoft clips a coupon on that for 25 years. Well, that doesn't exist in our space. Products come online. They have a natural life, and then it expires as a function of the patents. And so the innovators, the big commercializers, need to acquire innovation constantly, not just to grow their business, but to maintain their business. And so that's a core driver, and that's what's driving the liquidity in our space. And that's called loss of exclusivity. So, I think there's these really nice set of drivers. And I think the other thing is, I think in the IT space, one of the challenges has been all the antitrust stuff and the lean econ issues. And the good thing is we don't face a lot of those issues because our companies are often acquired just as they're becoming revenue generating. So we don't face antitrust issues. And in fact, typically, the acquisition of our companies into these big commercializers increases competition as opposed to decreasing competition.
Well, I appreciate all that backdrop and obviously the good stuff that's coming out of the industry. But let's talk about stuff that you've also been pretty vocal about, okay? So we've got the pension fund issue that a lot of people in Canada are up in arms about. There's two sides to this conversation. One is people think that the pension fund should be investing more in Canada and supporting more local economies. And other people are saying, well, given the size and nature of some of these assets and firms, they can't even write the minimum amount of check to give to some of these up-and-coming companies in life sciences or other industries. Plus, they're focused on more long-term real asset building rather than maybe speculative assets that we're seeing in the venture and startup world. You wrote a post about this about a month ago, or I believe talking about the article that was written in The Logic about how Canadian pension funds should not be investing in Canada's riskiest assets, mostly naming venture funds, given the underperformance of the Canadian venture market. But outside of Quebec, we're still not seeing that happen. So what are your reasons behind why there's been such a controversial take on having Canadian pension funds investing significantly in sectors like life sciences or ag tech or even AI for domestic innovation?
Let me maybe give you 2 examples of why I think they should be in the sector, and I'll put it in real sort of concrete examples. So if you look at those 10 companies that I talked about that got liquidity, the transactions that are $1 billion plus, if you look at who funded those companies and then who funded those funders, here's the data. Of all of those liquidity events, there were 96 US pension funds that funded those funders. There were 5 European pension plans, and guess what? There were 3 Canadian pension plans. So all that value that was created in Canada is accruing to foreign stakeholders. And so that value capture in our mind is something like 80% of the total value capture on these companies. That's tragic for the Canadian economy. That's tragic for pensioners. And so this argument that you can't make money is superfluous. It's just not true. Everyone else is coming up here and doing it. Like I said, 96 US pension plans just in those 10 deals. That's a huge macro. So the argument that pension plans can't play is ridiculous. Now, how can they make a difference? I'll give you another very concrete example. We have a company in our portfolio called Histosonics. This is truly transformative innovation in the cancer care space. It's non-ablative surgery for liver cancer. The company got approved last year. It's been transformative. The company is scaling at a rate that's faster than any other robotic surgical platform in history. We're super excited about this company. Obviously, this company has attracted lots of acquisition interest. And what's been really, really, really cool in this company, we've had 2 pension plans in this company as key stakeholders for now probably a half a decade or so. The Wisconsin pension plan and the Michigan state pension plan. And what those pension plans have done is given us optionality. So when other people have been sniffing around to acquire the company before it gets to full value, the pension plans have been very good about signaling, guys, we are here to support these companies. We believe in this company. We believe in how this company can grow. We believe in how impactful this company can be. If you want to sell the company, we will be supportive of that. But if you don't want to sell the company and you believe there is an opportunity for significant more value creation and impact, then we're here to support you. We're going to do that on economic terms. We're going to be a rational investor, all of those kinds of things. And so that optionality has really been transformative. And today we're on a journey where I think this company is going to return our entire fund. But if we'd have done the typical behavior of, let's take an exit the first time it comes up, it would be a nice return, but it wouldn't be transformative. Now we're in a position for this to be transformative. And that's really been enabled by the stakeholder group. Look, we obviously have some really good corporate partners. We have some really good VCs. But having that depth of capital really provides optionality. And look, that's the rule for the Canadian pension plans. I don't expect them to write early stage checks. They need to be partners with you and me and the guys who are actually building the companies. But then what they need to be thinking about is how do they take co-invest and start to partner with us to help these companies scale to another level so that they have optionality and we have value capture in Canada. That's the mission. Like, I'm not trying to jam them into a square box, but I'm saying this excuse that you can't deploy capital just doesn't add up when everyone else is doing it.
So, yeah, exactly. How do you think other people are able to do it if their size is somewhat similar, maybe not as big as CPP, but some more of the provincial funds? Like, how do you think they're able to do it?
Let's use CalPERS or CalSTRS, right? They're the same size, billion-dollar fund of funds. Billion-dollar fund of funds. Like, that's how they do it, right? They're not writing individual checks. They're not participating on an individual level. That's not the way that they're engaging. They're doing a fund of funds. So what would be amazing in this?
And what do you think about the argument about it doesn't move the needle, even if those are home run funds individually?
So that is the most superfluous argument on the planet. Because if it doesn't move the needle up, it doesn't move the needle down. And the argument that it can be negatively impactful is then superfluous. That's a ridiculous argument for anyone to make, frankly. And I think what venture gives you is optionality, right? If we construct our portfolios right, we can drive a really good return. And if we construct our portfolios super well, we create the optionality of delivering a premium return. And when these funds talk about creating alpha, I mean, CEO of CPPIB has talked about this, it's guys like you and me that are in the business of creating alpha, right? That is what we do. Like, we're trying to be deep, dedicated partners. We're trying to be value-added partners. We're trying to do unique diligence, make bespoke decisions around how we allocate capital. So if you want to get alpha, partner with guys like us and then figure out how you double down by co-investing beside us as our companies start to scale and reach that maturity where they can feel more comfortable about allocating capital. So the other part of this argument that doesn't make sense to me is, in 2021, and these guys were writing checks into the space, right? I mean, CPPIB put $165 million into one biotech, right? That's a whole fund.
Teachers put money into FTX.
Yeah, I don't buy that argument, right? If they wanted to do it, they could do it, and they've demonstrated they can do it. So, it's about other stuff. And again, I just think the fund-to-fund approach is the most rational approach. And look, if you really want it to be successful, I think you have them collaborate, you have them put together their capital in a pooled fund-to-fund. You hire a third-party manager to do that, or you can hire one of the groups that are out there today, and you then set up a co-invest strategy, and suddenly you've got a core amount of capital, and you've got the ability to bring in more capital with a lower management fee, which again I think appeals to these guys, and it's exactly what they do in PE.
So similar to VCAP, Vicky kind of program, but done by the pension funds instead of the Canadian government.
I think so.
Okay.
Right. And that's the way to play the ecosystem.
Why is Quebec so much of a thought leader in terms of their pensions and their state or their provincial funds being such leaders of investments in some of these more private assets?
I think it just comes to a cultural thing, right? Where they believe that the pension plans have a fiduciary role in supporting the domestic ecosystem. And I've said this publicly, so I'll say it again here. Look, if it wasn't for the Quebec-based plans like the FSTQ and Fund d'Action, frankly, the life sciences part of venture in this country wouldn't exist. Like, they just wouldn't exist. Those guys have been long-term engaged partners. They've been thoughtful. They've built their own teams in the space. They've had, quite good returns in the space. So it's been accretive to their overall P&L. And they've taken a very, very long time horizon on this, right? The FSTQ has been doing this now for, almost 30 years or 25 years, right? So I think these guys have done what you need to do. You have to have a long horizon. You have to have a multi-cycle horizon. You have to understand that it's not about getting into the peak. It's about being a continuous player across that spectrum. And I think they are, passionately believing that this kind of a virtuous ecosystem builds the local economy and drive real returns. And I think they've demonstrated they can do it quite successfully.
Yeah, absolutely. So to summarize, okay, for a long-term strategy that's well-funded for Canada, you suggest there is a fund-to-funds program similar to Vencap. There is a team structure around this long-term mindset like they've done in Quebec. And there's a cultural shift to supporting domestic innovation. Anything else you'd include in that strategy?
Yeah, I think the co-invest part's important because that's how you get even more engagement of capital down the road, right? And again, I think that drives also behaviorally, if they're now writing a $50 million check to a company or a $100 million check, again, it drives the learning curve. It gives them a cheaper cost of capital and the deployment of that capital. It drives engagement, so I think those are all positive parts of the ecosystem. And again, it parallels what they're doing in their private equity practices.
Okay, perfect. Thank you for that. So switching gears, you obviously had a bit of a hot take on the online recently when you attended a UK in-person event. So you went to basically the Canada House, which was hosted by Ralph Goodall, and there was basically a conversation that sparked a lot of controversy or conversation online regarding the CVCA CEO and the missed opportunity that was there at the event for Kim to take advantage of. And so I just want to set the stage here. Obviously, the event was hosted with international LPs' interest in the Canadian innovation economy as the agenda. And obviously, this was not taken very well, I guess, or presented very well by the CVCA CEO. Can you give us a little bit of a background? You obviously have been a part of the CVCA for a long time. I believe you were the chair as well. So what exactly happened and why is it that you decided to speak publicly about this?
This initiative came really from Global Affairs Canada. And there's a CVCA secondee who was actually a global affairs person. And they started to set this up months ago. Went to GPs like us and said, hey, we want to do this event. We think it's creative to the ecosystem. So, fantastic initiative, exactly what they should be doing. Kudos to Global Affairs. And then they get a guy like the Right Honorable Ralph Goodall to come and attend and, bring the gravitas to the whole meeting. So all of that was really good. Unfortunately, I think this is kind of meeting 101, right? So you've got a half a dozen GPs, you've got a bunch of allocators coming. So there's no pre-meeting. There's no pre-meeting between the GPs who are coming and the CVCA to say, hey, look, what's the agenda going to be? What are we going to cover off? What are we going to talk about? How are we going to promote our industry? How are we going to advocate for rents? We don't have that. Then a day before the meeting, we get an email comes out and it's a topic list. And 2/3 of the topics are negative. And so I respond back and say, hey guys, this is supposed to be a positive meeting, right? We're trying to get allocators to look at Canada in a positive light. We can't have 2/3 of the discussion be on negative topics, right? I mean, it's fine if negative topics come up and we can address them, fully and completely, but we have to have a strategy here to talk about this in a very positive light. And one of the things I put in my notes was, look, and I think we've got to be prepared to talk about the whole pension plan issue and the non-engagement of the pension plans, because I think it's actually a competitive strength for Canadians, Canadian funds. We have succeeded despite the lack of that capital source. Canadian VCs have been very creative about finding capital to do what it is that they want to do or need to do to help build the innovation ecosystem, right? We get a quarter of our capital from high net worth families. We get a quarter of our capital from corporate investors. So we've done things that are just different. So there was an opportunity to kind of have that pre-conversation that didn't happen. So then we get into the meeting and there's a few opening comments. And then we turn the meeting over to a 45-minute presentation on the Canadian economy. There's no presentation from the CVCA that says, hey, look, here's the evolution of the ecosystem. Just do what I did. You go back to 2010, you talk about the restart, you talk about what that's meant, you talk about the sectors, where growth has been, you talk about who the leading GPs are, you talk about what the profile of success looks like in Canada, you talk about some of the successful case studies and how they evolved and the kind of companies they are, you talk about where you think the capital allocation opportunities exist in Canada. None of that happened. None of that happened. So you've missed an opportunity to engage these people with a really thoughtful discourse. And during that presentation, when you talk about IT, you get the IT managers to add into that conversation. When you talk about life sciences, you have life science. And so you have this holistic event, which is all tied off a CVCA presentation that is about advocating for the aggregation of capital into our space. And then obviously, I articulated in my post where the meeting really went off the rails was when this question of pension plan engagement came out, right? And saying that they're performance-based investors and therefore they're not in the asset class is just throwing the whole industry under the bus. And that's not right. The CVCA's job is to advocate. It's interesting. As a prep for this, I want to look just as a reminder what the NVCA describes their mission as, right? The national, U.S. to advocate for policies that create U.S. economic growth and fuel entrepreneurship. That's it. That's the whole purpose. Nothing else. And frankly, that's what I think the CVCA's job is, right? To advocate for our space in an absolutely unequivocal way. That data that I gave you about the 96 pension plans, that should have originated from the CVCA, not from me. I shouldn't have to do that work. I shouldn't have to tell that story. The CVCA should be telling that story. That should be original research that comes from the CVCA that talks about this is why there's such an opportunity that's being missed by the pension plans in this country.
And was that the mission when you were there, when you were senior at CVCA? Has it changed, do you think?
Well, that was 100% the mission. Look, when I took over as the chair in, 2011 or 2012, I can't remember what year exactly, we had to go through a fundamental reset, right? The CVCA was a bit broken, so we went through a fundamental reset. We had a great board. We had a really great executive committee, all senior seasoned people. And look, we made the decision, which is super hard, to do a complete reset, right? So we fired the entire team from CEO down, and we rebuilt from the bottom up. And we hired Mike Willett as the first new CEO. And Mike was a fantastic hire and really just got it and really spent time to understand the industry and met with all the stakeholders in the industry and really just became very entrenched in what it meant to be the CEO. And then we did a bunch of things that were really fundamental, right? We recaptured all the data capture from Thomson Reuters. We fired them, got them out of the data capture thing. We recaptured all that data so that the CVCA could control all the data and therefore the messaging around how you advocate for the industry. Then we worked very collaborative with the government on VCAP, which came out in 2012. And again, this is the other thing that people forget. We also worked very collaboratively with the government around the whole LSIF issues. And people forget this, but there was a very controversial issue in 2012 around what should happen to labor-sponsored funds. And there were two different types of labor-sponsored funds. There was what was happening in Quebec, and there was what was happening in the rest of the country, frankly. And what was happening in Quebec, they were all called labor-sponsored, but what was happening in Quebec, they were building pension plans. And that was not what was happening. And so we went to Senate hearings, we advocated for understanding the differences, the nuances, why one group was completely different than another. And ultimately, it worked out incredibly well, right? The Quebec labor-sponsored funds have become a huge part of the ecosystem. And the other part has just gone away because it wasn't driving the kind of performance that matters. And I think that's the opportunity here to engage with the pension plans. You take the people who are the industry leaders, you try and have thoughtful meetings and nuanced meetings around a conversation that says, how can we work together to get the most out of what we collectively want to achieve in this country and can bring to the table? And look, frankly, a board member proposed that to the CVCA chair 9 months ago, and he was roundly shut down. It wasn't me, it was another board member. He was roundly shut down, and the message was, we've got it, we don't want your involvement, we don't need your involvement. And I think that's a mistake. This is a member-driven organization, and member engagement matters. When Mike and I used to talk about messaging, I always said to Mike, you got to have a hot list. Who are the top 5 or 6 VCs that you should reference when someone calls you about messaging? When someone calls you about something that Matt knows or Peter knows, make sure that you send that off to Matt or Peter so you get an insider's view and a VC's view or a private equity member's view, not just your view, Mike. And Mike was fantastic at that, right? And I think we've lost that connectivity to the members here, particularly the VC and PE members. Right? It just seems like...
I want to different. It's the CVCA, but there is PE, private equity, and venture capital a part of this. So did you get a lot of other feedback that you thought was interesting? And was any of the comments that were either written on the post or your post itself even received by CVCA? Were there any follow-up conversations you had without getting into specifics?
No.
Okay.
No follow-up.
Interesting. Wow. Okay. I thought feedback would be well received. And
I got tons of feedback directly from stakeholders. I've had probably over 200 messages from stakeholders, both on LinkedIn and privately, right? So lots of people thanking me for posting and lots of people saying, this is important. I'm glad you articulated it. And lots of people talking about, we need to advocate for our industry and we need to be passionate advocates for our industry. Look, again, one of the other things I learned in London that was so frustrating, and it wasn't the CVCA thing, but I met with 3 GPs in the morning who were in my space. And so we were talking about Canadian success stories, right? Because you want to promote the industry and you want to talk about Canadian. And of the 10 stories we talked about, all of those UK-based GPs thought they were American stories.
Wow.
Right? That's horrible.
Wow.
Like, it's just horrible, right? Right? They're like, no, those are American companies. I'm like, no, they're not. They're Canadian. Here's the origin story. Here's the VC in Canada who backed it. Here's how it developed. Like, no, these are not American stories.
But it's because the U.S. probably ended up becoming larger investors and maybe more headlines and media coverage in the U.S.
And they're the last capital in, right? They're the last big rounds. So that's what happens. But again, that's what I think our association needs to be doing, right? Tell those success stories, tell those origin stories. Make it clear that those are Canadian companies and the transformative Canadian companies are being built here that are going and competing on a global scale and being acquired on a global scale or going public on a global scale. That messaging is just not coming through. I mean, I was shocked. That was a real lesson learned for me in London because I just, hadn't had that happen.
Well, I thank you for sharing that online and for bringing it to a lot of other people's attention. I think feedback is definitely something that people should be aware of, especially in membership-driven organizations. So thank you for sharing that, Peter, and talking about it with us today. I want to switch gears here, back a bit to the biotech industry. Obviously, there's a lot of conversations happening around the GLP-1s and the impact and the sub-benefits these drugs are having, like Ozempic, Wegovy, Mounjaro, on society. I was listening to the CEO of Eli Lilly on the All In podcast interview the other week, and he said that they're testing over 200 sub-use cases for GLP-1 benefits, like chronic conditions of, kidney disease, heart disease, liver failure, so many others. I mean, you've posted about this obviously as well. How significant is this shift toward treating obesity and all the other diseases associated with it, and it impacting the way you look at investing in the sector?
Yeah, I don't think I can overstate how important this shift is, even if I wanted to. I mean, as little as 18 months ago, people were saying this could be, an $80 to $100 billion opportunity. Now people are saying, this is a $150 billion opportunity by 2028. I just saw the first analyst reports talking about this being a $200 billion opportunity by 2030, right? So there is no drug category that has ever looked like this before. And again, as we start to talk about this category, two things that are really super noteworthy. Both Lilly and Novo owe all of their metabolic franchises to the University of Toronto, right? Their diabetes platforms.
Well, hold on a second. Let's not overstate that a little bit because they didn't have the commercialization. The creation of it was, or discovery of it was, but not the commercialization.
100%. But we gave it away for no value. That's the mistake, right? That's the mistake. And by the way, with the GLP-1s, people forget that Daniel Drucker, who's also at the U of T, is one of the fathers of the GLP-1. So we continue to have a lot of engagement around this space and thought leadership in this space. And look, it is tragic that the University of Toronto has not been a bigger beneficiary of this. But anyway, let's get to the topic. So you're 100% right. And in fact, my partner is interviewing the CEO of Lilly Canada next week at the Capitalize for Kids conference. And this is exactly the topic that they're talking about. The new indications are potentially transformative. And you already alluded to a bunch of where that work is going. We're beginning to see implications in potential addiction management and all kinds of other spaces that are likely to be pretty transformative. And for the industry, I think that's got really 3 pretty profound effects. There is going to be a whole series of businesses that are going to be wiped out, right? Just completely fundamentally changed. So, the simplest example is Jenny Craig on Weight Watchers. Jenny Craig is bankrupt after 44 years, and Weight Watchers went from being a $4 billion market cap company 3 years ago to a $100 million market cap company.
Mission accomplished then.
Yeah, boom, right? They lost a lot of weight, right? And then in areas and I think you alluded to this, sleep apnea, there's a lot of innovation in sleep apnea, but some new data that's come out around the GLP-1s has said for a pretty significant slug of the population, being on the GLP-1 is likely to mitigate your sleep apnea. So it doesn't mean that new innovation still can't come in that category, but the TAM has probably fundamentally changed. The market that they're going to be able to address is going to be more complex, harder to get to because the easy people are probably just going to get relief from their sleep apnea by being on a GLP-1. And then if you look at what's happened on the orthopedic space, as an example, when people lose weight and they start to get mobile again, they need fewer hip implants, fewer knee implants. So there's a whole tiering of effects that come from these drugs. I think the next wave of kind of what's going to happen here is going to be innovation that makes the current GLP-1s better. And that's going to focus mostly around toxicity and, or side effects. And the big side effect right here is muscle mass loss. It's a big issue. It's a problem. The other thing is there's a whole population of people who are non-responders or lesser responders. So looking at ways to tweak it out. There'll be new, I think, innovation around a form of delivery. So a pill form versus an injectable form. And then I think you're going to look at a bunch of combination therapies where you put other drug analytes beside these drugs and look for incremental effect either on weight loss or less muscle density loss. So we're going to see that generation. And then I think there's a whole generation of kind of new innovation that's going to go everything from how you manage these patients, how you provide compliance to these patients, how you more personalize and tailor these innovations. I think you're going to have a whole new generation of therapeutic targets because, again, people thought this was a psychological disease, if you will. And now we've shown that it's actually a manageable disease in a completely different way. So,
yeah, as I mentioned, the knock-on effects are huge. 200 sub-use cases is what the CEO of Eli Lilly mentioned. It's phenomenal.
We haven't seen a drug category like this before.
But then you got to also talk about the other side of things, which is regarding the insurance side and the payer side, and how Robert Kennedy Jr. just said that if Trump wins, he's going to push for a $1,500 rebate for anyone who wants to be on GLP-1s because of how much it will save the healthcare system in the U.S.
Yeah, look, so I think that's the big challenge, right? Payers are always challenged with how you pay with something that fundamentally changes or bends the health curve, right? So what you're doing now is you're suddenly putting a new cost that's an immediate cost to something that was a long-term chronic cost that they didn't have to pay with or deal with, for many years down the pipeline. And you're making it much more acute. These drugs are already much cheaper in Canada, so it's not as nearly as big an issue in Canada as it is in the U.S. I think the drugs here cost a fifth or less of what they cost in the U.S., so it's a completely different cost curve.
Well, I think it's like $1,500 or plus a month, and then you can get it for $600.
Here it's $290.
No, I'm saying in the U.S.
Yeah, in the U.S., right. So look, they're going to have to figure it out. It is a real issue, but the health benefits are going to be exponential, right? I mean, when you look at just the cardiovascular data, forget all the other stuff, it's transformative. And in the US, cardiovascular disease is the number one killer, right? So you stop having people die of cardiovascular disease, that's pretty transformative in the savings to the health system and the benefits of having those people live. But it's complex, right? People are going to spend a bunch of time trying to figure out how they manage this. And the problem is, these are the kind of things that can bankrupt health systems if you don't figure this stuff out in a pretty logical way.
Yeah. I mean, it feels, Peter, like, in the world that I live in, like, SaaS and enterprise SaaS, the revolution that AI is bringing to way that companies are being built and sold is changing the way that older businesses, and when I say older, I mean like only 4 or 5 year old businesses that were built before AI was really at the forefront, and how destructive it is to the way that those business models can survive. Are you thinking about it the same way with GLP-1s in terms of some of the investments you've already made over the last 5-10 years, whether it's some of these sub-use cases and the solutions that you've been investing in, and how maybe GLP-1s could impact the business cases for those even needing to exist going forward?
Look, it's a huge question. I think we're pretty fortunate that we don't have, I don't think we have any companies in our portfolio where today we fundamentally believe the GLP-1s have mitigated their business case. But look, we spent a significant amount of time last year looking at sleep apnea. It had been a disease indication on our long-term radar. We saw significant market opportunities there. We were very cognizant of the fact that there was a clinical readout coming from the GLP-1s in sleep apnea. We were very close to funding a company, but we wanted to wait until we saw that data. That data came out and we didn't fund the company. So the answer is it's definitely affecting how we think about the things in our pipeline. And, the spaces where we think we can make money or not make money, as the case may be, right? And we're trying to pretty consciously avoid anything that we think is on the margin.
Totally. I would say the same thing. You'd have to think about it looking forward. Speaking of AI and its impact on healthcare, obviously we're seeing a ton of drug discovery platforms being funded in the space. We've seen some in Canada as well. How are you viewing this space? What are your thoughts around, how AI is impacting the drug discovery process? And given all the experience you and your team have, where do you separate sort of like fact versus fiction here?
Yeah, so we've spent a fair amount of time on this over the last, 2 years. We've recently brought a guy into our team who's pretty knowledgeable in that space. And he's been working with us now for a couple of years, but he's now full-time part of the team. We haven't been chasing the drug discovery part of the equation very hard. There's just so many players coming into that space. It's very crowded. We think valuations don't reconcile with the potential opportunity set. And I think people haven't really, got their head around the fact that drug discovery matters and finding new targets and new compounds matters. But that's about 10 to 15% of the cost curve of our business, right? So even if you make that as zero, it's not bending the curve or changing the time frame in quite the way that a lot of people articulate. So it's important, and I'm not going to say it's not important, but what we are looking for more in our portfolios are companies who are using AI to do what they're trying to do better and faster. And I would say we already have AI, seriously part of the platform in a half a dozen of our companies. And then as we look ahead, I think in our space, what we're really going to see is some significant transformation around the medtech space. The ability to use data, particularly in anything that has an imaging component to it, is fundamentally changing because of AI. And we think that there's going to be a whole generation of medtech solutions that are going to be fundamentally better enabled by the use of AI. And they're going to become much more accretive targets because they're going to bring to the acquisitors a whole data set that is unique and a lens that is unique and a set of intellectual property that is unique. And so that's going to make those companies just fundamentally more valuable than they would have been 3 years ago. So we have not done a medtech deal in Canada since 2016. We continue to invest in other markets and very successfully in other markets. But I think it's going to be quite transformative here in Canada. And, we're just out raising our Fund 5, but we already have our first Fund 5 deal in our pipeline, and it is a company that fits exactly these criteria. So, we're excited about that.
Oh, interesting. So you're talking like radiology, cardiology, dermatology.
Anywhere where that imaging component is important, I think those companies are going to just be completely differently enabled.
Yeah, we're seeing a lot of acquisitions there and the treatment planning side of it as well for cancer treating.
That's exactly right.
Yeah, we actually, Peter, you'd be proud, we made our very first biotech investment, even though we're not a biotech fund. It was a software company called Catalyze AI. It's more on the biomanufacturing side for quality assurance and helping large players like Sanofi and Pfizer and so on manage their facilities for the production of drugs. Just dipping the toe in a little bit there.
And that just seems to make tremendous amounts of sense to me. Yeah, we don't play in those spaces, but I totally get how the application works there.
What are your thoughts for emerging entrepreneurs in the life science space in Canada? Where should they be focusing their attention? What areas do you want to see entrepreneurs coming to Lumira with ideas that they have to disrupt the incumbents on and that you're looking to back?
It's a pretty broad spectrum, right? I mean, we are still a very active investor in oncology, in immunology, in inflammation, in autoimmune, cardiovascular, in CNS. I'd say the growth areas today are spaces like CNS. We've seen a real revival there. And part of that is, AIs and new technologies are really enabling it. The brain is obviously the most complex part of the human anatomy, but we've seen some transformative acquisitions recently. We've seen a lot more capital getting engaged in that space. So I think that this is actually a pretty interesting time. I mean, capital is still hard to get, particularly early stage capital in this country, I think is, particularly hard to get. Look, the quality of IP in Canada is fantastic. And I heard some stat the other day about just how much, sort of fundable IP comes out of Canada relative to the US. And it's really quite a stunning number. We're seeing a generation of entrepreneurs and repeat entrepreneurs that I'm super excited about. And then look, we're trying to tailor our strategies to be more bespoke in how we kind of service the market. So we're out raising our core Fund 5, which is a traditional fund that does what we do. But we have 2 times out of the last 3 times we've raised the core fund, we've raised a strategic fund in parallel. And those strategic funds give us a different lens and a different insight that we think is accretive to the ecosystem. We just announced a couple of weeks ago that we're going to launch a new strategic fund in partnership with the Terry Fox Foundation. That's all around cancer. And so we're calling it the Cancer Breakthrough Fund. And part of that will coattail with what we're doing in oncology in our Fund 5. But part of it is to bring more capital into the early stage ecosystem to support oncology innovation. We're also spending a lot of time with the University of Toronto trying to figure out a collaboration there that allows us to do more with them. The University of Toronto has been fantastic, I think, in really thinking about how to support innovation in life sciences, but I think in the broader sort of innovation ecosystem. They built out some great infrastructure to support that, some great processes to support that. And frankly, I think the university deserves more allocation of capital. And so we're trying to figure out with them, how do we do something bespoke that allows us to bring more early stage capital to them and then provide the continuity of capital through our Funds 5. So look, I think for entrepreneurs, the lessons are probably the same ones that you would say. I think you've got to be, tenacious about this. You've got to be creative and differentiated about this. In our space, you've got to be mission driven and super passionate. I mean, I think if you don't bring that passion to bear, it's hard for me to get excited if you're not excited, right? Like that's just the way it is. I think you got to be bold, and I think you got to be relentless. Relentless is an important word here because, we'll often hear from entrepreneurs, I did 30 calls and nobody jumped, and, I'm kind of sad now. When we go and fundraise, we do 700 calls, right? To get like 40 or 50 people, right? I think you got to be relentless, and if you're good, you've just got to turn over every single stone. And I think entrepreneurs are getting better at that. They understand that. They understand there's no free rides, and, you got to just relentlessly pursue. And I think with guys like us, and we tell everyone this, look, engage with us early. And if we can be helpful, we'll be helpful. If we can be thoughtful and introduce you to other people in the ecosystem, we'll do that. We like that. And again, if you look at our portfolio, most of the companies are companies we met years ahead of when we invested in them, right? We got to know them. We built a relationship with them. As they started to achieve their milestones and hit their expectations, we ended up funding them. Histo is a great example. That one I talked about that I think is going to return all of our Fund 3. We turned that company down, I think 2 or 3 times. We knew them for 5 years before we did the deal. And then around a new reset around clinical target and a new CEO, we stepped in and supported them along with some other good VCs and corporate strategics. And it's turned out to be an incredible investment for us.
That's incredible. 5 years of tracking and 3 no's. That's still, that's dedication there, Peter, and thank you for sharing all that. As you say, we're GPs who get told no 100 times too while fundraising. So we know what it's like being entrepreneurs.
People forget that, right? We get a lot of no's too.
We do. Absolutely. All right. Before we wrap things up, we always jump into our fast favorites. So first off, your favorite podcast.
I like the All In, but I'm now listening to Acquired quite a bit. It's a deeper dive, 3-hour podcasts around really interesting topics, and I think the guys do a really good job.
They are fantastic. And I saw they hosted their first in-person one at the JP Morgan Chase Center. Which one's your favorite of the 3-hour or 6-hour Microsoft ones? Which one's your favorite?
I like the kind of whole Novo Nordisk one. That history is again, just because of what I do, it's kind of interesting, right? But there's been tons. There's been all kinds that I've liked. So
I always come back to the Costco one. I think that should be taught in every single business class around the world. It is one of the best ones I've heard. Next is your favorite tech gadget.
I think some of the new AI tools. We were using some of the new stuff from Google the other day. I mean, it's phenomenal. We giving an example, we put together a pitch deck for this new fund that I was talking about, the Cancer Breakthrough Fund. We ran the deck through the AI, and then we asked it to create a podcast. And it did this podcast that was 10 minutes long. It was unbelievable. And we gave it to our partner, and we said, we hired these 2 guys to do this, and we didn't hire anybody. It was just it was just done through AI. And they're like,
was there audio to it or just a script?
Full audio. And what was incredible is the AI. So we talk about just the size and impact of the disease. And at one point, one of the 2 commentators goes, "Can you believe that? That's bigger than the economy of some countries." I'm like, we didn't say that, right? It picked that up and added that into the text. And it's a woman. It was a woman and a man who were doing the conversation, and it made 2 small mistakes.
That's awesome. I got to try that.
It was holy crap, right? And so we're telling our companies now, run your decks, because think about this. It's a completely unbiased way to hear what is being extracted from the deck. What is the story that someone else is hearing?
I'm going to try that on our next fund deck.
No, dude, it was, we're that is just ridiculous. Absolutely ridiculous.
Very cool. All right. I'm going to try that. Next is your favorite new trend.
Rationality in the venture market. No, seriously, it just feels a lot better. So it's a new trend, and I'm really super happy for it.
No, it's definitely coming back to basics, kind of like the time, I'm sure, when you started. As you said at the beginning of the conversation, a lot of the newer VCs had never experienced what a downturn or lack of capital really has felt like. And now they're getting to feel it, which is probably good for everyone in the ecosystem.
Absolutely.
Last but not least is your favorite life lesson.
I think it's never give up. I mean, I think you probably know a little bit of my personal journey, right? I got really sick 5 years ago. It was bad. And, my personality is a never give up personality. And because of that, I got through with my family and support from my friends. And I think never give up is just an incredible life lesson. And look, I think be passionate. No matter what people say, I think passion drives everything, and it's what matters at the end of the day. Passionate people get more done. Passionate people are more engaged. And I think they're just fantastic people to hang around. So be passionate and never give up.
I love that, Peter. I'm sure you're going to like this, but in my home gym, I actually have a massive poster that says never give up. That's it. That's all it says in my gym at home.
I love it. I'm on that page,
Awesome.
man.
I'll send you one too. Thanks for joining us in the tank again, Peter.
Thank you.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.